April 13, 2026. A U.S. naval blockade closes on the Strait of Hormuz. Oil jumps 8% in a night. The S&P 500 futures lose 517 points before breakfast. And yet, this is not the story. The real story is quieter. It sits in 3 lines that the White House itself 3 years ago called non-negotiable. No territory to Russia. No softening on China. No weakening of NATO. 3 red lines carved into every speech, every executive order, every podium in Washington. Today, all 3 are gone. One by one, in just 18 months, Donald Trump has given ground on each of them. Not on TV, not in a single dramatic moment, in press conferences that blur into each other, in summits that end early, in tariff rates that quietly shrink while nobody reads the fine print. The dollar already knows. It is down 9% against a basket of major currencies. The Supreme Court knows. In February, it gutted the tariff weapon that made Trump look invincible. And European chancelleries know too. They are building backup plans that a year ago would have been treason inside the Beltway. This is not a story about politics. It is a story about power, about what happens to a $27 trillion economy when the man in the Oval Office stops being able to dictate the rules. And above all, about what it means for the money sitting in your brokerage account, in your dollar cash, in your American ETFs. 3 red lines. 3 retreats. And a bill that nobody has started adding up yet. To understand what is happening, you have to go back to the inauguration. January 20th, 2025. The speech was clear. 3 lines in the sand. 3 doctrines that would define the second Trump term. The first was Ukraine. No more American money for a forever war, yes, but also no rewarding aggression. No internationally recognized transfer of territory to Moscow. Trump himself used a striking formula. I can end the war in 24 hours, but I'm not giving Russia a prize. The second was China. Tariffs as a hammer, the fentanyl crisis as leverage, a strategic rivalry openly declared. The promise was total. Squeeze Beijing until it gives in, on trade, on fentanyl, on technology. Peter Navarro spoke of a 60% tariff wall. Howard Lutnick, in Commerce, talked about bringing 40% of Taiwan's chip supply chain back to American soil. The third was NATO. Reform, yes, but also reaffirmation. Article 5 as an iron clause. European allies had to pay more, raise their budgets to 5% of GDP, buy American weapons. In exchange, Washington stayed the guarantor of the Atlantic Order. That was the deal. And that is the Trump the voters elected. The unfinished Reagan. The man who is going to put America back on top. Now fast forward 18 months. On Ukraine, the United States has formally agreed, inside the Geneva and Abu Dhabi draft plans, to de jure recognition of Crimea as Russian, de facto acceptance of the territorial gains Moscow made since 2022, a permanent ban on Ukrainian NATO membership, and a gradual lifting of sanctions on Russian oil and banking. The Donbass becomes, in the text, a demilitarized zone. An area the size of Delaware is written out of Ukraine's sovereignty. On China, the Busan deal of late 2025 lowered U.S. tariffs on Chinese imports from 57% to 47%. The White House removed another 10 points linked to fentanyl. Port fees on Chinese vessels, gone. Export controls on advanced chips softened from a presumption of denial to case-by-case review. Then, in February 2026, the Supreme Court killed the IEEPA tariffs altogether. The legal hammer is broken. In exchange, Beijing promised soybeans, fentanyl enforcement, and rare earths, promises it has broken before. On NATO, Trump has openly threatened, in April 2026, to pull out if European allies don't commit warships to the Strait of Hormuz within days. He has posted on Truth Social that Article 5 could be invoked for the southern U.S. border. The Secretary General, Mark Rutte, is now playing firefighter inside European capitals. 3 lines, 3 collapses, and every single one of them started with a promise that the other side will come to the table begging. They didn't. What makes this moment unusual is not the retreat itself. Every superpower at some point negotiates down from its opening position. Reagan did it with Gorbachev in Reykjavik. George H.W. Bush did it at Malta. Even Eisenhower pulled troops out of Lebanon in 1958 under pressure he never mentioned on camera. A great power that never concedes is not a great power. It is a caricature. What is unusual is the scale and the speed. 3 core commitments, 3 different theaters, all conceded inside 18 months without a single corresponding gain. Not one territorial deliverable, not one Chinese concession enforced, not one European ally persuaded. Just a series of press releases describing the retreat as a victory. That gap between the narrative and the ledger is the thing worth watching. Because markets, unlike voters, cannot be persuaded by a press release for very long. Here is the part nobody wants to say out loud. Trump didn't cave because he is weak. He caved because the 3 red lines were built on a single assumption, and that assumption cracked. The assumption was simple. The rest of the world needs America more than America needs the rest of the world. Pressure hard enough, long enough, and they will fold. That was true in 2018. It is not true in 2026. Start with Russia. The Kremlin watched Ukraine bleed for 3 years. It absorbed sanctions. It rebuilt its war economy on Chinese components and Indian oil buyers. By the time Trump sat down in Alaska with Putin in August 2025, the Russian economy was not on its knees. The Russian budget was in deficit, yes, but the war machine was self-financing. Putin didn't come to bargain. He came to collect. He got the vocabulary he wanted. Land swaps, a phrase that sounds neutral, except one side is taking territory by force, and the other side is losing land it governs. He got Zelensky, exhausted after 3 years of war and shrinking European support, signaling flexibility on NATO, on military size, on territorial concessions in Donetsk. According to the latest Carnegie Endowment analysis, the asymmetry is brutal. Ukraine twists itself into knots, while Moscow makes no substantive compromise at all. The Trump team believed tariffs would break Xi. It didn't happen. What happened instead is that the US auto industry came within 2 months of shutting down. That was a direct quote from a Toyota executive, because China holds the rare earth cards. 92% of rare earth processing runs through Chinese facilities. When Beijing tightened its export licenses, Detroit panicked. Washington caved first. And then, February 20th, 2026, the Supreme Court delivered the coup de grace. The IEEPA tariffs, the legal authority Trump used to threaten every trading partner on Earth, were struck down. The president scrambled to put a temporary 15% surcharge under another statute, a tool that needs congressional approval in 150 days. Trump's main leverage against Xi evaporated weeks before their scheduled April meeting in Beijing. Xi doesn't need to negotiate. He only needs to wait. Now NATO. This one is subtler, but it is the most dangerous. Trump's pressure worked partially. European defense spending rose. Poland crossed 4% of GDP. Germany passed a €1 trillion security fund. Good numbers on paper. But the cost of the pressure was the loss of trust. And trust in military alliances is the only thing that actually makes them work. European capitals have started writing contingency plans that assume American absence. France and the UK are reactivating the concept of Article 42.7 as a pure European defense mechanism. Rutte himself is quoted as saying Europe must prepare for a more limited and more conditional US role. The paradox is cruel. By threatening to leave NATO, Trump accelerated the very outcome he said he wanted to prevent, a Europe that no longer needs him. 3 red lines, 3 moments where the bluff was called, and a White House that keeps pretending each retreat is a deal. There is also a 4th dimension that analysts in Washington quietly acknowledge, even if they won't put it in a memo. Trump's personal tolerance for a market crash is, bluntly, 0. His entire political identity is built on the idea that his presidency means a booming Dow and a booming Nasdaq. The moment the S&P began to wobble in March, every hardline posture softened within 48 hours. Iran, China, Russia, each time the market flinched, Washington blinked. Foreign policy called it the one thing that terrifies Donald Trump. Moscow and Beijing figured out the pattern before Wall Street did, so now they price Washington differently. They know exactly how long the bluff lasts. They know the exact ticker level that forces a retreat, and they structure their demands around it. That is not strategy. That is a hostage situation in which the hostage is the American president's own approval rating. Because here is what they won't tell you. Each of these concessions has a price tag, and the tag is not paid by the politicians. It is paid by the dollar. The dollar is a political document. When foreign central banks, sovereign funds, and global investors buy treasuries, they are not making a financial bet. They are buying a signal. America is predictable. America is powerful. America's word is the last word. The reserve status of the dollar rests on that signal, not on charts, not on yields. Now watch what happens when that signal fractures. Since January 2025, the dollar has fallen 9% against a basket of major currencies. It is at its weakest level since March 2022. Trump has said publicly that he welcomes this. A weaker dollar boosts exports. A weaker dollar makes American debt cheaper to service in real terms. He is correct on the mechanics. He is catastrophically wrong on the second-order effects. Because the price Americans pay for a weak dollar is imported inflation. Every barrel of oil, every Chinese-made appliance, every French wine, every Indian pharmaceutical ingredient, every piece of Taiwanese silicon, all of it becomes more expensive in the shopping cart. The savings of American retirees, already bruised by the 2022 inflation shock, get eaten again. Then there is the bond market. As the dollar weakens, foreign buyers demand higher yields to hold treasuries. Higher yields mean the US federal government, already carrying around $37 trillion in debt, pays more to service each year. Moody's estimates the extra interest burden at close to $400 billion annually by 2028 at current trajectories. That is almost the entire US military budget gone to pay creditors. On Wall Street, the dynamic is already visible. The S&P 500 holds up thanks to the AI rally and Nvidia, but under the surface, the market is no longer leading. The MSCI Europe Index is outperforming the S&P 500 year to date. Gold is at record highs. Bitcoin, again. These are not coincidences. They are votes of no confidence. And then there is the geopolitical bill. On Ukraine, a settlement that rewards Russian territorial aggression sets a precedent, not only for Ukraine, but for Taiwan. Every chancellery in Asia is reading this in real time. If the United States accepts land seizure as a basis for peace in Europe, what does it do when Xi makes a move in the Taiwan Strait? The answer, Tokyo and Seoul suspect, is exactly what it did on Ukraine, and they are building silently accordingly. On China, a trade deal that gives Beijing the rare earths it wanted and the chip access it needed in exchange for soybean purchases it was going to make anyway, is not a deal. It is a capitulation with a press conference. The 40% chip supply chain relocation target from Commerce Secretary Lutnick is now, quietly, a 15% target by 2030. Nobody in Washington writes the word retreat, but the spreadsheet writes it for them. On NATO, the damage is structural. Even if Trump reverses course tomorrow, the European buildup of autonomous capability will continue. Strategic autonomy has gone from Macron fantasy to Berlin policy in 12 months. The United States will still sell weapons. It will not still sell reassurance. Markets are already pricing this. The euro crossed $1.23 in March. Gold hit $3,800 an ounce. Chinese equities are having their best quarter in a decade. Bitcoin is flirting with $180,000. This is not a tech story. This is a trust story, and the trust is leaving Washington by the boat. For an independent investor, the questions become very concrete. dollar exposure has to be reviewed. Not abandoned, the US is still the deepest, most liquid, most innovative market on Earth, but rebalanced. 15 years of near total dollar dominance in global portfolios is ending. Even a modest rotation toward euro assets, toward physical gold, toward emerging market equities outside the Chinese sphere starts to make sense on a risk-adjusted basis. US tech remains the queen of the board, but concentration risk has never been higher. 7 companies account for nearly 35% of the S&P 500. In a world where the American narrative is cracking, that concentration becomes a political risk, not just a financial one. And then there is the less comfortable idea. The idea that for the first time since 1945, the global order is no longer running on an American default setting. It is running on a multipolar negotiation. China, Russia, the EU, India, Saudi Arabia, each playing a weaker Washington for maximum leverage. This is not a prediction. It is what the last 18 months of concessions literally look like. A few domestic indicators reinforce the story. Rural MAGA counties, the same counties that delivered Trump his 2024 margin, are watching agricultural employment drop by roughly 155,000 jobs since mid-2025. Soybean farmers now sell to a Chinese customer who was never actually going to buy more than the minimum stipulated in the Busan deal. Small businesses absorbed an average of $151,000 in extra costs between April and September 2025 because of the tariff whiplash. Surveys suggest 1 in 6 Trump voters now express some regret. That is not noise. That is the coalition that was supposed to last 10 years cracking in its second spring, and the market is smelling it. When Moody's put the United States on a negative outlook in March, the statement was almost polite. Translated into plain English, it said, "Your politics can no longer be separated from your creditworthiness." The phrase political risk premium on treasuries used to apply to Argentina. It now applies to the reserve currency itself, even if nobody in the Treasury Department wants to say it out loud. This is the world Trump is leaving his successor, not the chessboard he promised, a chessboard where 3 white pieces have been traded for 3 handshakes, and the scoreboard belongs to the other side. 3 red lines, 3 quiet retreats, 1 empire still calling itself exceptional. 50 years from now, a historian will write this chapter. They will probably focus on a detail that nobody covers today. Maybe the tone of Putin's smirk at the Alaska press conference. Maybe the exact word on the Beijing fact sheet that replaced the word tariff. Maybe the minute Rutte called Berlin in April 2026, sweating to say, "Please do not quit him publicly, not yet." The interesting question is not whether Trump caved. The cables are clear, he did. The interesting question is what Americans believe about America now that the 3 red lines have been crossed and the sky did not fall on the news cycle. Because perception is a lagging indicator. The dollar has moved, the gold price has moved, the Chinese equity market has moved, the Beltway narrative has not yet moved. It will. And when it does, when the word decline becomes acceptable again inside American newsrooms, the way it was acceptable in the late 1970s, the investor who saw it coming will not be the one panicking at the headlines. It will be the one who noticed in April 2026 that the 3 non-negotiables were already gone, and that the bill was already being written in a currency that nobody wanted to read. The scoreboard doesn't lie. The question is, who is still pretending to play?